There's two things that are really straining the cash reserves in the financial system. One is that the US government has now just resulted to T-bills. So these 1 to 3 month debt instruments, they're just puking them, constantly issuing these. So it's really pulling cash reserves away from sitting at the Fed, okay? The other is that the government's been shut down. And so when you see Bitcoin chopping around, going down a little bit, guys, again, it's telling us something. Think of Bitcoin's price. Don't be mad at it. Don't get emotional about it. Think of it like a truth machine. It's speaking to you. When Bitcoin's going down, what it was telling us is there's not enough liquidity in the financial system. There is a risk of a financial crisis.
The core message emerging from Jack Mallers' latest analysis is simple yet profound. The plot is hiding in the plumbing of the financial system, and Bitcoin can already sense the next wave of monetary expansion. As Mallers argues, the United States is drifting deeper into fiscal dominance, a regime where government deficits dictate monetary policy rather than the other way around. This shift is not theoretical. It is visible in real-time behavior inside the funding markets that serve as the backbone of global finance. Rising instability in overnight funding, surging demand for short-duration treasury financing, and the growing stress on reserve balances all signal the same structural deterioration. Within this backdrop, Bitcoin behaves not as a speculative toy, but as a truth machine, reacting cleanly to distortions that traditional markets attempt to mask. Today's analysis explores why this liquidity pressure matters, how it mirrors emerging market dynamics, and why Bitcoin is already pricing the next phase of monetary debasement.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
Let's go. Title of today's show is The Plot is in the Plumbing and Bitcoin Can Smell the Printer. Fiscal dominance continues to strengthen. It's becoming a serious problem. And as I've told you guys before, Bitcoin is a truth machine. It's telling you the realities of the world around you. Things like the US government, things like the stock market, things like the Federal Reserve. These things are distorting reality. They're manufacturing volatility to be down. They're engineering risk out of your life. They're not telling you the truth. They're not telling you what's real. Bitcoin is. It's in fact, I'd make the argument Bitcoin's the only free market we have left in the world. And so as the plot thickens, and the plot to me is in the plumbing, it's in the financial system, it's in the pipes, and the pipes are breaking. Seeing Bitcoin bounce around, seeing it react, seeing it move 5% up over the weekend as the US government seems to be coming back, and as Trump is introducing stimmies, brrr, you hear that? Shh, shh, shh. You hear that? That's the money printer. It's really interesting to see Bitcoin move. So first and foremost, for chapter 1 today, let's talk about fiscal dominance, when deficits set the monetary policy. For those that don't know, fiscal dominance is when, first of all, there's the US government, which is financed by the US Treasury. So, we've talked about Scott Besson, our boy Scotty B. Scotty B is effectively the CFO of the US government. He's in charge of financing what the US government needs. The US government needs military, US government needs health and human services, it needs to pay interest on its debt, it has expenses. And it's Scotty B's job to make sure that those expenses are met. And they're met either with income and revenue, like tax receipts, or they're met through financing new debt and selling things like T-bills, okay? Then you have the Federal Reserve. The Federal Reserve is supposed to be an independent central bank. The Federal Reserve is not supposed to be a part of the US government. The Federal Reserve is supposed to be independent central bank, not political, okay? Now, whether that's real or not, we all know that the Federal Reserve is highly political and they exist to perpetuate the regime that is the Pax Americana, the empire. But that aside, they're supposed to be two independent things. Now, the concept of fiscal dominance is when the needs of the US government and the needs of the Treasury and the needs of Scotty B to perpetuate all Trump's plans and all politicians' needs to get reelected, when those needs and desires outweigh and crowd out the quote-unquote independence of the Federal Reserve. So when I say when deficits set monetary policy, deficits is our government deficits, all the debt that we have created in the past and continue to create to march forward, it is setting monetary policy. It's demanding new money printing. It's drying up liquidity. And that is a very dangerous place for a government and a currency to be in. This is emerging market behavior. Okay, this is like Argentina. Okay, this is behavior where the government is so indebted, the only way out is to print a bunch of money. And that's what I mean by fiscal dominance. Okay, so first screenshot. I've been throwing these terms around, SOFR, IORB, there's all sorts of stuff. I had a thesis last week on the show that maybe the US government is purposefully shut down to dry up cash reserves in the financial system to force the Fed to do what the government needs them to do. That this would be an egregious manipulative form of fiscal dominance. I have an updated thought on that, actually. And so I want to walk through in detail, relative detail. This isn't the show to get too tight. You're not going to get a PhD listening to me ramble, okay? So relative detail, but more detail than usual. So first and foremost, this is from the Federal Reserve Bank of New York website, okay, as you can see in the screenshot. And this is literally from their website, secured overnight financing rate. So when I say SOFR, that's it, SOFR, secured overnight financing rate. The secured overnight financing rate, SOFR, is a broad measure of the cost of borrowing cash overnight collateralized by Treasury securities. Okay, boom, simple. I'm not even going to read the rest. So it's the cost of borrowing cash, money, collateralized by, call it, US Treasuries. Okay. Next, from the Fed's website again, what is IO, interest on reserves? The Federal Reserve pays interest on reserve balances. That is that IORB that I keep referencing. The Board of Governors has prescribed rules governing the payment of interest by Federal Reserve banks in Regulation D. So it's very simple. IORB is the interest you get for parking your cash at the Fed. Okay. SOFR is the cost of borrowing cash collateralized by treasuries. Okay. Now, what's been happening recently that has all these economists up in arms and panicking is that SOFR, the rate for SOFR, so the rate to borrow cash collateralized by US Treasury securities, has exceeded the interest on cash. Okay, that is a big deal because traditionally it's not supposed to work that way. It's intended to be the opposite. Okay, you do not want the cash reserves being lent out. The system is designed so that the interest on cash parked at the Fed pays you more than the secured overnight financing rate. Okay. Now, recently, this rate, let me pull up the chat. Recently, this rate has done the opposite. You can see here, it's typically, I don't want to say there's a target because there's not actually a real target, but generally in a healthy market, it's about 10 basis points below. So you can see here, this 0.1. This is a healthy market. We're seeing relative. January 2022 through 2023. And then you can see some unhealthiness at the end of last year. And it started to get a little volatile. It started to spike a bit. And now it's really gone vertical very, very recently. And if I go to the next slide here, this happened in 2019. So last show, I referenced that this type of imbalance, and I know it might not make sense now, just let me get through these slides. I'm reading some of the chat. This imbalance happened in 2019, right before COVID. Now, not the exact same, not SOFR over the interest on cash, but the same practice is that cash reserves got very, very scarce. The Fed implemented something called their Standing Repo Facility to basically fix this problem going forward.
Mallers highlights a critical imbalance at the center of the system. The secured overnight financing rate has recently moved above the interest earned on reserves parked at the Federal Reserve. In a healthy market, the opposite should occur. When borrowing against Treasury collateral becomes more expensive than holding risk-free cash at the Fed, the message is clear. There is not enough liquidity to absorb the government's relentless supply of short-term debt. This shortage is magnified by the Treasury's increasing reliance on very short duration bills rather than 10-year or 30-year bonds. Investors will lend to the government for a few months, but they refuse longer-term exposure to a heavily indebted issuer. The result is a drain on deposits, money market funds, and institutional cash pools. The Standing Repo Facility has already been tapped for tens of billions, echoing stress last seen just before the 2019 repo crisis. Bitcoin's recent volatility is not noise. It is a signal that systemic liquidity is tightening to dangerous levels.
So this is again from the Federal Reserve Bank of New York's website. What are the Standing Repo Facility's operations? At its July 2021 meeting, the Federal Open Market Committee, FOMC, established the SRF, the Standing Repo Facility, to serve as a backstop in money markets to support the effective implementation and transmission of monetary policy and smooth market functioning. That's a very fancy, professional, Harvard-educated way to say we stood up this facility where if there are no reserves, if people need printed dollars to get financing in these markets, they can come get it. We will give it to them. So the Standing Repo Facility was created after the 2019 drama and crisis that we saw in funding markets. And it is effectively a facility created by the Fed to give freshly printed dollars to protect the rate of these funding markets. Let me check the chat. Does that make sense? So, in other words, guys, when the interest on reserve balances is over the SOFR rate, that means there's plenty of liquidity in the financial system, okay? There's plenty of cash to go around. When this happens, when the secured overnight financing rate gets higher than the interest on cash, that means there's more U.S. Treasuries flooding the market that need financing than there is cash to finance them. That's the easiest way to think about it. When the market's operating normally, there's plenty of reserves, there's plenty of cash in the system. When it's not, when you see spikes like this, that means there's not enough cash to finance the amount of U.S. debt that's being issued into the market. So now we keep going, and if you guys have questions on this, I'm happy to answer in the Q&A. So now we keep going. If we look at this repo facility that the Federal Reserve stood up, okay? So again, this was a facility to protect against these funding crises. When the market gets super illiquid, there's not enough cash reserves to finance the government. Guys, what's a U.S. Treasury? A U.S. Treasury is you're lending to the U.S. government. Scotty B is issuing these things and raising money to continue to fund the U.S. government because the U.S. government runs about a $2 trillion annualized deficit a year. As the world reserve currency issuer, it's implied you have to run these massive deficits. So when we look at how active the Standing Repo Facility has been, this will tell us how much newly printed money these market participants needed to continue to fund the government. If you look on Halloween night, it was tapped for $50 billion. And you can see relative to other nights and other days, now, hopefully and traditionally, it's never tapped at all. You don't need newly printed money to sustain and finance new T-bill issuance, new U.S. debt. But the reason everyone was up in arms about this, including myself, is because you can start to see the system falling apart. You can start to see there's scarcity in reserves within the financial system. There's not enough cash. And the thing that people don't actually understand is that it's T-bills, it's the U.S. government that is issuing these short duration debt instruments. That's the reason there's not enough cash. If the U.S. government finances itself with 10-year treasuries, so they're borrowing money and they don't need to refinance or owe it back for 10 years, for 30 years. That's a lot easier on Scott Bessent and the U.S. Treasury. They don't have to constantly be raising money, refinancing it, rolling it over. When they're raising T-bills, so all of the U.S. government debt issuance since like halfway through Biden's term with Janet Yellen and now in the first year of Trump's term with Scott Bessent, they keep going to the front end of the curve. What that means is they're not doing 30 years or 10 years or even 2 years. They're doing like 1 to 3 months. Like what Tether buys? Tether is buying T-bills. So yes, they are buying U.S. debt. They're buying very short duration. That puts a lot of pressure on the U.S. government, particularly Scott Bessent, to be able to finance all of this. And so you're flooding the market with new T-bill issuance. When you have so much T-bill issuance flooding and hitting the market, it pulls all the cash out of the system, right? So think about it. All of our bank deposits, money market funds, endowments, these are the predominant lenders to the US government. They're buying these instruments. If Scott Bessent, instead of issuing like one load of 10 years and not having to worry about it for a while, he's constantly issuing these T-bills, these shorter instruments. And sorry if I'm over-explaining to those that know this, but when you ramp up that way, you need a lot more cash liquidity to finance the US government. Now, if the US government could lend at 10 years, it would. But no one's buying that dog shit. Nobody's buying that dog shit. And so the way they kind of kick the can down the road is they say, okay, will you lend to us for 1 to 3 months? We understand that no one wants counterparty risk with the US government. We're $37 trillion in debt. There's inflation on the horizon. There's all sorts of problems. No one wants a relationship with us for 10 years as a counterpart. Will you take 1 to 3 months? And someone like Tether says, yeah, I'll take 1 to 3 months. That's virtually risk-free. I mean, at the end of the day, you're at least going to give me new printed dollars. You can't default. And if I have to take future inflation risk for 1 to 3 months, for 30 to 90 days, that's reasonable, right? And so that's what's drawing all of the liquidity out of the financial system. And you see the results of this when you see that SOFR starts to exceed the interest on reserves at the Fed. And when you see the Standing Repo Facility get tapped for $50 billion, this is $50 billion printed US currency to protect this market and prevent it from exploding and causing a financial crisis. Okay. And so I showed the screenshot last week. I'm going to show it again. Joseph Wang. The Fed will need to expand its balance sheet by several hundred billion a year and may start in December to head off year-end funding pressures. A structurally rising TGA, an insatiable demand for repo financing leave them little choice. So last week, my idea was, and it's not mine to own, by the way, like guys like Luke Roman, there's a lot of people that have these ideas, which is, well, hold on a second. There's two things that are really straining the cash reserves in the financial system. One is that the US government has now just resulted to T-bills. So these 1 to 3 month debt instruments, they're just puking them, constantly issuing these. So it's really pulling cash reserves away from sitting at the Fed, okay? The other is that the government's been shut down. The government's been shut down. The TGA, the Treasury General's Account, so think of it like the US government's checking account. So the account that Scott Bessent manages to finance the United States, it's been frozen because the United States hasn't been turned on. Someone unplugged the government. And so the TGA has reached $1 trillion worth of balance. And so when you see Bitcoin chopping around, going down a little bit, guys, again, it's telling us something. Think of Bitcoin's price. Don't be mad at it. Don't get emotional about it. Think of it like a truth machine. It's speaking to you. When Bitcoin's going down, what it was telling us is there's not enough liquidity in the financial system. There is a risk of a financial crisis.
The overarching takeaway is that fiscal dominance is now the primary driver of United States monetary conditions. With deficits exceeding trillions per year, the Treasury General Account swelling toward $1 trillion balance, and short-term issuance saturating global liquidity, the Federal Reserve will eventually be forced back into balance sheet expansion. Mallers frames Bitcoin as the last functioning free market, an asset unburdened by political incentives or engineered volatility suppression. As liquidity tightens, Bitcoin briefly softens. As liquidity injections loom, Bitcoin front-runs the inevitable response. For investors, the lesson is clear. The funding markets are flashing structural stress comparable to pre-crisis conditions, and Bitcoin is already positioning for a renewed phase of monetary debasement. In an environment where traditional assets reflect policy engineering, Bitcoin continues to reflect reality. Stay informed, stay analytical, and follow the signals that truly matter.